Hello, my name is Todd Salamone, Senior Vice President of Research at Schaeffer's Investment Research in Cincinnati, Ohio. I have been with Bernie Schaeffer for over 25 years, since 1993, and thus have plenty of options trading experience. As you may know, Schaeffer's provides education to traders seeking to learn more about options. Moreover, we provide option recommendations, and we do this with our real-time alert services, but we also provide option recommendations via our bulletins, which come out on a particular day of the week or time of the month. Today, I am going to focus on 10 option buying mistakes you cannot afford to make. Who knows, maybe there's 11 in this presentation, but the key is whether you are an experienced option trader or an inexperienced options trader, these are concepts that you can keep in mind in order to ultimately achieve bottom line success as you move about with your options buying. So let's dive right into it. The first mistake is trading without an edge. When I talk to people, I hear many talk about the same indicators. And as you may know, if everybody's using the same indicator, it is hard to make money. So, therefore, trading off indicators the crowd is using is not a good idea. In other words, avoid crowded trades. When you're in a crowded trade, you are using indicators, again, that likely everybody else is using, and therefore it's hard to take advantage of the option pricing model, which is important, especially when you're buying options. We at Schaeffer's have a rule that our traders must follow, and that is, after we make an options recommendation, we have to send around notes about, and in those notes, there has to be at least one or two things that we know that most do not know about the options backdrop or the stock backdrop. And part of this that involves an edge is using quantified data. Specifically at Schaeffer's, we have quantitative analysts that are in constant communication with our traders. Our traders will make observations that they see when they're going through literally thousands of charts. And these observations, when they are unusual, we'll have our quantitative analyst go back and create screens that we think are an edge. For example, here is one screen that is routed every day to our traders. This is one of several, keep in mind. And again, this is data that is quantified, but it's unusual to help us avoid crowded trades, but it's also useful. Because again, it's based on a lot of observations our traders see, and it's useful in that the data is actually quantified in terms of the implications. So for example, we know most technical traders use moving averages, but we also know that many of them use the same moving averages. A 50-day moving average and a 200-day moving average come to mind. And there's no doubt that I have seen stocks that are either rejected or supported by those moving averages. And that happens. But what about those moving averages that are off the radar of traders, such as this 80-day moving average, which we, by the way, have found on many stocks to act as support or resistance just as much as the 50-day moving average. Therefore, and what we have found then is while many traders may be exiting a trade because a stock breaks quote-unquote support at its 50-day moving average, as it moves lower, a moving average that is off the radar as these other traders move on is the 80-day moving average and could very well provide a great buying opportunity. So this is an example of a screen that, again, we route every day. It shows stocks that are trading within their 80-day moving average. It goes back and looks at how that stock behaved on past pullbacks to the 80-day moving average over a 5-day and 21-day period. Now, again, not all stocks react well when pulling back to this moving average, but if we see a stock that historically has done well, it'll be on our radar, and we will do deeper research into those type of setups. And again, this is one of many quantified, unusual, but useful data screens that we receive each and every day so that we can then in turn provide option recommendations to paying subscribers. Another mistake, front-running drivers. If you are an option buyer, and whether you're a trader or an option buyer, in fact, it helps if you know yourself. Some people, for example, are impatient and they just feel the need to get involved in the action. But that, if you know yourself, you can create rules. And one rule might be do not front run any of your drivers. So if you're waiting for a pullback to, say, the 35 level and the stock's at 36.50, it'd be a mistake to jump in at 36.50. Why is that? Well, as an option buyer, you have a certain time defined by the expiration to be correct. And therefore, if you correctly identified support in 35, but it took some time to pull back to that level, if you jumped in and front ran your driver, time decay is eating away at you, and you are running out of time depending on how long it takes to pull back to 35. And this also creates a lot of whipsaw action. If it does pull back to 35 and you're cutting losses, you may have a sizable loss on that trade, and it may cause you to get out of a trade early or premature, even though the setup is still there. So if you're constantly front-running drivers, that will add to lower win rates and lower average wins. Think about it. If you would have waited and bought the option when the stock was at 35 instead of 36.50, you likely paid a lower premium. And if you are correct and the underlying indeed rallies off the 35 level, your leverage potential is much greater because you paid less for that option. So front-running drivers leads to whipsaw, premature exit, lower win rates, lower average wins because you paid more for the option, and you get out at a smaller profit when the target's achieved, and it leads to what we call sloppy entries. Another mistake is allocating too much capital to a position. And I will get into, this is driven by a couple things that come to mind. First, sometimes there's the mentality of the next trade has to be profitable. And what I'm referring to is this table to the right. And what it shows you is the probability of seeing at least X consecutive losing trades within a 50-trade period. And it's based on the expected win rate. And I'm going to be honest, if you're an option buyer, you're going to have, depending on the type of options you're playing, anywhere between a 35 and 45% win rate over time. Why is that? Well, let me explain. First of all, the best stock traders, portfolio managers, whatever, have about a 50% win rate. They make money overall because they are very disciplined. They let their profits run and they cut their profits short. But these stock traders do have a couple advantages over an option buyer. The first is they can hold a stock for as long as they want and have a winner. Now, yeah, there might be an opportunity cost to holding that stock, but unlike the option buyer, they have an infinite amount of time to be correct. Whereas the option buyer, again, as defined by the expiration date, has a certain window of time where he has to be correct about the direction. Also, option buyers are paying a time premium. The more time they buy, the more time premium is embedded in that option price. And time premium decays as in a nonlinear rate as the option approaches expiration. So those are a couple headwinds the option buyer has, which causes a lower win rate than that 50% I was talking about with successful stock traders. So if you have a lower win rate, you have to have something to achieve bottom line profitability. Now, if you have a lower win rate in the 35 to 45% range, let's say it's 40%. Notice in that table to the right that there's a 63% chance, roughly, that you can have 6 losing trades in a row. Now, let's say you're coming to an expert like us, Schaeffers, for option trading advice, and you just experienced 3 losing trades in a row. Well, Bernie Schaeffer and his staff are the experts. The next trade has to be a winner. No, it doesn't. But what does that mentality create? Well, I just lost on 3 in a row. I'm going to double up or I'm going to triple down, whatever, on this next trade because it has to be a winner. No, it doesn't. That's a recipe to lose even more money. Also, allocating the same dollar amount to options with different risk-reward characteristics. Another mistake is buying the cheapest options or failure to understand and manage the Greeks. The 50-cent option versus the $5 option. A lot of inexperienced option buyers will be drawn to these 50-cent options. I mean, yes, we have been, it's in our brains, buy the cheap, buy anything cheap, buy low, sell high. But it's also, a 50-cent option on a $100 stock is likely out of the money. And therefore, those type options may have anywhere from a 90 to 100% chance of expiring worthless. Those are the type of options, in fact, that even if you're right on direction, but not right enough, it can still go on to a 100% loss. In the money, so having an understanding of in the money options, which have a higher probability of finishing in the money versus out of the money options. And that goes back to that point that I just made about allocating. A mistake people make is allocating the same dollar amount to out of the money options and in the money. Out of the money options give you higher profit potential, but they also are higher risk in terms of the number of times that you're going to experience a total loss. So you should be allocating much less money to out of the money options relative to in the money. And then also short term versus longer term until expiration. If you can, allocate more money to the longer term options because that time decay isn't working against you as quickly. So let's go back to allocating, a mistake being allocating same dollars to options with different risk-reward profiles. And I'm sorry, I realize I am jumping around, but sometimes visuals provide aid in what I'm talking about. Let's talk about a couple scenarios. An option buyer likes a particular stock, XYZ, that's trading at $107 a share. Now, the problem with options is there's so many quote-unquote options available to you when you decide you want to trade. Do you buy the short-term 100 strike in the money option for $9? It's more expensive, so one contract will cost you $900 since one contract represents 100 shares of stock. So you multiply that 9 times 100. Or you can buy the 110 strike out of the money option. So if you're buying a call option and the strike price is above the current price of the stock, it's considered to be out of the money. And that's only 90 cents. So right there, if I'm new to options or I'm inexperienced, why would I buy a $9 option when I can go out and buy a 90-cent option? So I'm like, you know what? In fact, if I'm going to spend $900, I may as well buy 10 contracts. And now, instead of only having one contract for $900, I've got 10 contracts for $900. Not a good idea. Why is that? Let's say the shares are unchanged at expiration. If you're the in-the-money option buyer with the stock at 107 and the right to buy the shares at 100, you can sell that option for $7. 107 minus the 100 strike. That's going to give you a $200 loss, or 22%. But now, look, if you're the 110 strike buyer, if you can go out and buy the shares in the open market for 107, no one's going to be interested at expiration to buy that option from you for the right to buy it at $110 a share. Therefore, that option is worthless. So that $900 investment you just made is now a $900 loss. In other words, you lost 100% of your investment. So right there, that shows you the risk reward in those options. Higher risk with those out-of-the-money options. They're cheaper, but they're higher risk. Now, let's say the stock moves 2 points higher at expiration. Well, now the 100 strike option buyer breaks even because that option is worth 9. You take 109 minus the strike price. That gives you $9. You bought it for 9. You broke even before commissions. Now again, even though it's a call option and you anticipated this stock to move higher, and it did move higher by 2 points, again, the out-of-the-money option buyer lost $900. And let's go through that again. Why would somebody pay you for the right to buy the stock at 110 at expiration day when he can go out in the open market and buy the shares for 109? You've got a worthless option again, $900 loss. But here's where the out of the money can be advantageous. Let's say you're correct and this underlying stock rallies to 115. Now that option, the 100 strike option buyer, to the 100 strike option buyer, that option is worth $15. The 150, take 115 minus the 100 strike, 15, subtract 9, that's a $600 profit on a $900 investment. It's $67 profit. Nothing wrong with that. Now, check out the guy that bought the 110 strike option. That option is now worth $5. Correct? Now you multiply, and why is it worth $5? Take the 115 that the stock's at minus the 110 strike, and he bought it for 90 cents, and he bought 10 contracts. That's a $4,100 profit, or 455%. So again, since out of the money options offer you more profit potential, more leverage, if you will, but they also have a higher risk of expiring worthless, it would make sense to put less money in the trade. The higher the reward, the less money you need, and the higher the risk, the less you want to put at risk. Another mistake is the failure to understand the link between win rate, average win, and average loss. Now, when I go out to and make presentations in public, I have people come up to me and say, hey, I could achieve a higher win rate, and I believe them. But I also think that those that have a higher win rate trading options also tend to have a lower average win because they're taking profits quickly, which means any small profits they have are not going to reverse and move lower. And these are also the type that tend to, when they have a loss, they tend to hang on to those losses and hope for the underlying to reverse so they can realize a win. They're just in their head, they think that winning is everything. But in the process of having a losing position, most of those do not turn around, and because they're in hope mode, they tend to take worse losses. So again, if you know going in what type of win rate you're going to experience, you know the importance of having a high average win, a high average win to average loss ratio. So what this slide does is show you that you can have a lower win rate than someone, but also have a better bottom line profit. And I think that's what we're here to do. We're here to make money. So if you don't understand what your win rate's going to be, you're going to be in trouble. So here's an example where if someone has a 40% win rate, but has an 80% average win, well, that means they also have a 60% loss rate. But if they're out there controlling losses and they're disciplined in both letting profits run and cutting profits short, they can have 11% return on their $1 investment. So you would multiply 40% times 80% and then subtract 60% times 35%. And that gives you the 11%. So notice what I said before, though. Those with a higher win rate are probably cutting profits quickly, resulting in a lower average win, which you can see on that slide. And they're also holding on to their losers in the hopes it turns around to a profit. And what that creates is bigger losses. So here's somebody that has a better win rate, 50%, but has a lower average win, 30%. But he also has that 50% loss rate, and he takes a higher average loss, and look at his return on the dollar. Again, he's showing a pretty big loss, even though he's got a higher win rate. So unless and until you understand that you're going to have a sub 50% win rate over time when you're swing trading and buying options, you're not going to if you don't realize that you can make money by having a higher average win and lower average loss, then the failure to understand that is a huge mistake that will cost you in the end on the bottom line. Another mistake is just poor option selection. And again, and this is why a lot of people do come to Schaeffer's for trade ideas. Even if they have good trade ideas, sometimes they're not good at option selection, and there is just so many options that are available once you decide that you like a stock or dislike a stock. When we see implied volatility is high, and that could be high relative to historical volatility or high relative to the implied volatility relative to itself over, say, the past 52 weeks, we will tend to buy deeper in the money options. That is because, again, something I said before is time value. And when implied volatility is high, that means there is even more time value embedded in the option. And therefore, at the money options, since they're made up of 100% time value, and there's that time decay that is the enemy, the option buyer, you want to move away from buying options that are made up of 100% time value, and you can do that by buying deeper in the money options. Now, the trade-off is the time value does not impact the overall option price. The time decay does not have as big of an effect on the option price, but it's also going to lower your profit potential. Also, it's the indicators that you're using. And that comes to what type of expiration you're playing. Event driven, if there's a catalyst on the horizon, you may want to have a shorter term expiration play because you know there's a catalyst that can move this stock. We at Schaeffer's, we look at sentiment a lot. And if we see a stock that's in an uptrend and low analyst ratings or high short interest, we're looking at that on a contrarian basis. We're looking at it as the market saying one thing, stocks in an uptrend, good news coming. However, the analyst community is not yet on board, or the shorts aren't seeing what the market's pricing in, it may take time for the unwind of that sentiment to play out. So we may move out uh, as far as an expiration play. So moneyness, which means in the money, at the money, is a crucial factor, and also the expiration that you choose. You have to align your indicators with the expiration. Another mistake is being blind. The key levels not so obvious on a chart. And I will take you through a few examples. But one, let me give you a few examples. We all have our charts, and we all see moving averages, or we all see uh, past support resistance levels. Those are obvious. What about the not so obvious? Because that's important to an option buyer, especially if a stock's hitting a new high and you're a momentum trader, for example. Are you trading, buying calls or buying puts at a not so obvious resistance level, or buying puts at a not so obvious support level? It's very important. Average 12-month price target among sell-side analysts, for example. Do you have an awareness of that? I've seen many stocks hesitate at 12-month price targets. Again, that's not something that's sticking out on a chart. We we are amazed at levels that correspond to round number market caps and how stocks respect that. For example, um, again, on a chart, you're not going to see that at this level that corresponds to the $500 billion. Now there is a a website, www.koyfin.com, KOYFIN, where you can actually chart market caps. But always be aware of where a stock is from a market cap perspective. If it's trading right below a round number, that may cause you, if you're buying calls, to at least go out and buy time on it, or just wait for the stock to overtake that level before committing any dollars to a call option. Or levels that correspond to round number year to date or year over year return levels, 10%, 100%. I'm doing this presentation in 2019, and I would challenge anybody to go back, if they can, and look at the S&P and how it respected uh, either a year-over-year break-even level on pullbacks, or how it was rejected at the round 20% year-to-date level. Again, not so obvious on a chart. Um, Levels that are round number percentages above or below an IPO price, and that is very helpful, especially if you're trading options on IPOs. There's been a lot of uh, momentum names that have made a lot of money for call buyers uh, that were recently issued stocks over the past 5 years, for example. But it's amazing how once they reach double or triple or quadruple their IPO, how they hesitate or maybe even sell off from those levels. And as an option buyer, that is critical information for me, since because it's critical on the option I might select, or it might cause me hesitation before I get into a trade right as it's about to consolidate or even move lower. So here's an example of Visa, and note the horizontal line. And I think that's note the horizontal line. That equates to the $400 billion market cap level. And it's amazing how that stock was just showing tremendous upside momentum, and all of a sudden it stalls right at 184. Uh, again, this is a stock that was hitting highs, and any momentum player may be tempted to jump in, or maybe jump in right before the top. But again, if you're out there and you need big profits, even when that stock was trading at 180, you may have hesitated from making that trade because the premium you paid may not have allowed you to achieve at least a double, which is what we're shooting for on all of our option buying recommendations. We're always shooting for at least a double. So if we're looking to buy a 180 strike call when the stock's at 180, we're looking for that stock to hit 192 by expiration. And if we think 184 is going to be a challenge, that's going to give us pause, a lot of pause. So that's important. So that's one example of a stock just respecting a round number market cap. And I'm only showing you this one example, and if I had the time, I would show you a ton of others. And just check out this market cap history. The first shaded area, check out how it moved up to the 200 billion market cap and hesitated. And that was for a good year. And we've seen it. It's each situation's unique. Sometimes it might fly through a round number. That's fine, and maybe you trade based off that. You wait for it to take it out. But again, here's a situation where if you're waiting for it to take out a round number market cap, you may never got into a trade and got yourself in trouble. And then note the first circle. Oval, if you will, got up to 300 billion. Now again, if you're didn't stall as long as it did back in 2016, early 2017, but again, if you're a short-term options trader, that's good information, because if you're looking to put that trade on right as it's trading just below 300 billion, you're going that would have been a bad entry, because in the short term it did in fact pull back a little bit from that 300 billion, finally got through, and then notice how it came back and retested that, and there were some very short-term option buying opportunities on the pullback to 300 billion. And then when it cracked, there was a short-term opportunity to buy puts when it did crack that support level. And then finally that last rectangle is the example I showed you, where when it ran up to the 400 billion market cap, it sold off. Here's another example of, here's an example of what I was talking about before. Software stock, Okta, symbol OKTA. And then right here, there's a couple examples. The first pane shows you, this is 2019. It shows you the year-to-date, the daily year-to-date return on this stock. And the dotted horizontal line is right at 100%. And notice how that stock back in June ran up to 100%, and then it kind of went sideways around that level for a brief period. Finally broke out, and then when it pulled back in early August, that 100% year-to-date acted as support. So again, I was talking about round numbers, year-to-date returns. Not so obvious on most customary charts people look at, but something I think as an option buyer you need to keep in mind. The second pane that has the actual price of the stock has horizontal lines. Again, this is a stock that IPO'd at 17. If you take 5 times that level, which would be a 400% profit, notice how that stock stalled at 85 back in February and March of 2019. It makes sense. It makes perfect sense. You've got a lot of institutional dollars that likely got in at 17, and they're all thinking the same thing. They're likely taking some money off the table once it gets to 100%, 200%, 300%. Now again, each situation's unique. I've seen stocks hesitate just like this at these round number multiples above the IPO. I've seen it sell off. I've seen them get right through. But the important thing is having an awareness of how these levels can behave. Once it got up to 102, which is 6 times the IPO, or a 500% profit, back in April and May, it again hesitated at that level. That's something I want to know. If I like the stock, I know I probably, if the stock's right around 102 or just below, I probably don't want to buy short-term call options. I either want to refrain from doing the trade or go out in time and give this equity some time to digest some of the profit taking that may be going on amongst the institutions. Now notice at 119, it burst right through. It first went up, it gapped there for a couple days, it sold off, and then it burst right through, and then went up to, and that was 7 times the IPO. When it got through, it went right times 8 times the IPO at 136, got rejected at 136, sold off, and found support at 7 times the IPO. Ran up to 8 times the IPO again at 136 and kind of hesitated there. Again, just not levels that you're going to see on a technical chart, especially when you got a stock like this hitting new all-time highs shortly after the IPO, but they're levels to keep in mind nonetheless. Other common mistakes: focusing only on one time frame in your chart analysis. I can't tell you how many times I look at a daily chart and love something, then I move on to a monthly chart and this is a stock that's trading right at a previous support or resistance level. I may think twice about buying a call or a put right here. So I think, again, if you're impatient or you're somebody who wants action, you tend to get, we can all get in this mode of focusing on one time frame, maybe a daily chart over the past year or 6 months, and then fail to look at a longer term perspective and realize that, whoa, I may want to hold back on this potential trade. I have a checklist I follow. Before I trade, I have rules or questions. Before trading, did you check all time frames? And what I'm talking about is monthly, weekly, and daily charts. Reacting to intraday noise. Again, this is knowing yourself. If you're somebody that can get excited easily about something, get caught up in emotion, or you're an emotional trader, this is where a checklist can help. I will, for example, never trade something that all of a sudden I see is higher in the morning, and I look at the news. Oh, that looks great. And then if it's higher, and then turn around and buy calls. If it's a short-term option I'm looking at, and the stock just got on my radar after the open, I will never buy a short-term call on that stock because I think I'm reacting to intraday price action. I will at least wait till later in the day before buying the short-term call, or I will at least go out in time. I'm just sensitive about reacting to intraday action. Now, if I like a stock and I'm interested in buying calls, and the stock's pulling back in the morning, I have no problem entering a trade, especially a shorter term option, call option. Other common mistakes: treating the options like the stock. Again, you can be a very good stock trader, but a poor options trader. And again, because it's a different asset, it's a different vehicle. Options have expirations, and the pricing of options is determined by its implied volatility. In other words, how much the market maker thinks this stock can move over a given time period. So there's a lot of things to factor in. It's not that you got to look into. When I buy an option, am I getting a good deal in terms of how much movement's being factored in? When I'm holding an option, if I buy an at-the-money option, how am I managing the positions? If I'm buying an at-the-money option, it's made up of 100% time premium. So unlike the stock buyer that has an infinite amount of time to be correct, I have a definite time, and that time premium that I bought is going to start decaying. So I might really think hard about having a time stop in addition to a price stop. And also, not having diversified setups. It's a mistake if you only have one setup that you're going to. If you're a momentum trader trading breakouts, and you're in a market where there's rotation, and all of a sudden the momentum names get hit, and the market doesn't necessarily get hit, but they rotate into lagging sectors. If you don't have a pullback setup, in your repertoire, that's a recipe to really have some disastrous periods that can be detrimental longer term uh, to your option buying. So again, these are just things that I thought about when putting in this presentation, mistakes I've made myself in these 25 years, mistakes I know people are making when I'm going out on the road and talking in public to those that are seeking education on option buying, and you know, taking my experience, other people's experience. I think these are some of the most common mistakes I see. And I don't think you're going to avoid them all the time. We are human, but to the extent you can avoid these mistakes, the more you can avoid them, I think you're going to have higher potential of bottom line success over time. Thank you so very much for listening today. And I'll remind you, if you want to know more about Schaeffer's, go to our website or the various products, bulletins, and alert programs they offer. Go to www.schaeffersresearch.com. There is a wealth of information at that website, and information about products, information of what's going on in the stock market, options market. All the commentary is free and well worth it. Again, thank you for listening.